This video covers 15 common mistakes beginners make and how to avoid them. Let's dive in. First mistake, not defining financial goals. Simply put, investing without goals is aimless. I know this wasn't something I defined in my 20s, but in my 30s, I got better about it, and I got better about setting financial goals to get out of debt and to start investing more money so that way I could build that retirement fund that I'm gonna be needing later in life. You should understand that it's difficult to measure success without clear objectives, and if your goals aren't exactly defined, then it makes it hard to stay motivated during market fluctuations. So get those financial goals defined, and if there are adjustments that need to be made along the way, that's okay. Number two, procrastination. Delaying investing can be costly. You're going to miss opportunities for compounding growth. Also, you have less time to recover from market downturns, and you may need to take on more risk later in life than now to catch up. This is something that I'm fortunate to have done early in my 20s when I started investing and got that compound growth rolling. And so for those of you who are younger, get started as soon as you can. And those of you who might have waited a little bit longer, let's see if you can add a side hustle or do something to bring in some extra income that you can dedicate to investing so that you can start to build that retirement nest egg. The next mistake, emotional investing, letting emotions drive decisions. I see this happen so many times when people panic sell during market dips. Oftentimes people are chasing hot stocks based on hype. You see it in social media, on YouTube, Instagram, to go invest in this stock or this meme coin, and then what happens? Market dips, or that value of that investment dips, and it's no longer worth anything. Be mindful that your fear and your greed can cloud rational judgment, so be careful letting those emotions drive the decisions you make when you invest. Fourth mistake I see a lot of people make is trying to time the market. Predicting market movements is impossible. Very few people are successful at trying to time the market, and you don't want to do this because this leads to frequent buying and selling, incurring fees, incurring taxable events. Oftentimes, you're going to end up buying high and selling low because, like I said, trying to time the market is a fool's errand. It's not going to be something that the mass public is going to be able to do successfully. And then also, when you try to do this timing of the market, it's going to distract you from long-term investment strategies. The fifth investing mistake, ignoring diversification and not spreading investments across asset classes. Why is this important? Because if you don't do this, you will have an increased vulnerability to market fluctuations. Also, you have a higher risk of significant losses, and this ultimately limits your potential for a balanced growth. When you're investing, you want to make sure that you have some type of diversification within your investment portfolio. The sixth investing mistake, chasing past performance. Please do not assume past success guarantees future returns. Why? Because past performance is not indicative of future results. Yes, there may be some good history in terms of how this index fund or ETF has performed over the last 30 or 40 years, but when we're talking about single stocks, when we're talking about meme coins, cryptocurrencies in general, these isolated individual investments, I personally do not like looking at the past history to determine what the future outcome is going to be. Another reason why you don't want to chase past performance is because this may lead to investing in overpriced assets. A lot of times you're ending up in a position where you're buying that asset, that investment on the high end just before it either goes down or it just kind of stabilizes. And then in general, you want to be focused on the fundamentals, not recent trends. You want to make sure that you're educated on investing and make sure that you're not just putting your money into wherever the wind is blowing at the time based on what you're hearing or the different hype that's out there. Number seven, not understanding fees. There are so many hidden costs that can erode returns. And so you want to be aware of expense ratios, trading fees, and any other charges within your account, within your investment account that could take away from some of those gains that you would expect to have. Obviously, fees can significantly impact long-term growth. So you want to be aware of all the fees that come with investing. Ask that brokerage firm, ask that investment company, wherever you're investing, whoever you're investing with, what fees should I expect? Ask them that and they will tell you exactly what you need to know. And one way to combat fees is basically choose low-cost investment options. There are so many out there. I love index funds. I love ETFs because of the low fee structure that comes with investing in those assets and makes it better for me that I'm able to keep more of my money invested in the market or whatever investment asset class that I'm trying to build wealth with. Number eight, lack of financial literacy. Basically, not understanding basic financial concepts. concepts. So many times people who lack financial literacy have difficulty making informed investment decisions. Also, they could be vulnerable to scams and bad advice. There will be a video in the description that I talk about 7 money scams that you need to be aware of. So check that out after this video. With lack of financial literacy comes with a lack of confidence in managing finances. So you want to make sure you're educated, make sure you're reading books, watching sound advice from YouTubers that are going to tell you exactly what you need to hear, not what you want to hear, and understand that success with investing is a long-term journey. Don't think what you see with the person who's a billionaire overnight is going to happen for you. For the vast majority of us, that marathon mindset is important to investing. The 9th investing mistake, not rebalancing. Portfolio drift can alter risk exposure. Asset allocation can become unbalanced over time. Personally, I invest in the US total market, also an international index fund. So these 2 index funds, I'm split like 80-20. So understand, when one fund outperforms the other, I sell a little bit of that fund to make sure that I come back down to an 80-20 ratio. And that allows me to go and buy the fund that didn't perform as well, and ultimately balancing my assets at a ratio that I'm comfortable with. And it's important to know, if you're not rebalancing your portfolio, you do increase risk, or you could reduce the potential of your returns. So make sure that you rebalance periodically to maintain your target allocation. Number 10, if you're not doing your research, you're only going to expose yourself to some scams and ultimately losing a lot of money. So when you invest and do your due diligence. Don't rely on tips or hearsay. Sometimes family or friends will try to give me investment advice and I'll listen to them, and that's fine, but I also will make sure that I go do my research before I put my money into whatever is being recommended. So do your research. If you don't do your research, you're not going to understand the risks involved, and you might end up investing in something unsuitable or some kind of fraudulent scheme, a scam that you ultimately want to avoid. The 11th investing mistake, over-reliance on experts. You want to avoid blindly following advice without critical thinking. Obviously, not all financial advisors are created equal, and some of them have a conflict of interest that you want to know that exists. Yes, that does. So always do your own research and due diligence. If you see a bunch of reviews over this financial advice, or you start to see comments about this personal finance influencer, whoever this is that you're following, start to have some negative comments, well, be wary of those things before you just jump on some trend or some investment that they are promoting. The 12th investing mistake, ignoring risk tolerance. You want to be sure that you are not investing beyond your comfort level, because this can lead to anxiety and emotional decision making, and you could end up selling your investments at the worst possible time. It's very crucial to align your investments with your risk profile. Are you comfortable with seeing your investment portfolio drop 20%, 30%, 40%? That is going to determine what kind of strategy, what kind of investment allocation you're ultimately going to have. And that way, whenever the market does dip, you have other investments that are going to be able to carry that and hopefully not perform as bad during that time, to help you get through some of those financial storms, some of those ebbs and flows that the investing world obviously always brings to us. The 13th mistake, overtrading. Frequent buying and selling can often lead to increased transaction costs and taxes. And obviously, this is typically driven by emotions and market timing attempts. Let me tell you that this rarely leads to better returns and can only hurt you. So you want to be careful, if you are an active trader, that you're not putting yourself in a position where you're making emotional decisions, you're trying to time the market, and you're trading so often that the fees, the taxes end up countering whatever gains that you would have been able to make. The 14th mistake beginner investors make, not reviewing investments. Failing to monitor portfolio performance is a bad habit. You're going to miss opportunities to rebalance or adjust the strategy that's going to help you make more money in the market or whatever you're investing in. And you may not notice underperforming investments until it's too late. Make sure you're doing regular reviews, because this is essential for long-term success. The 15th mistake beginner investors make is giving up too easily. Don't be discouraged by market fluctuations. Investing is a long-term game. Setbacks are normal, but perseverance is key. I've been investing since 2010 when everybody was telling me not to do so, and I saw an opportunity based on the sound advice that I received to invest at a time where the market was low. And I'm still continuing to invest because I know that there's going to be ebbs and flows, there's going to be ups and downs, and it's important for me to continue to invest and let that money compound over the next 20, 30, 40 years. Otherwise, I'll lose that opportunity to build wealth. So yeah, setbacks are normal, and you don't want to let short-term volatility derail your long-term goals. Avoiding these common mistakes will significantly improve your investing success. Remember, this is a journey. Start early, stay informed, Be patient and stick to your plan. And if you're ready to start investing and you're ready to look at the different accounts, or maybe you've been investing and you're curious about what investment accounts that you need to invest in, check out the video on the screen. Otherwise, check out the other video on the screen that YouTube says you should watch next. Peace.